Good afternoon, everybody. I welcome you all to the SEPS webinar to discuss whether corporate insolvencies resulting from the deep recession linked to the COVID-19 pandemic could or not jeopardize financial stability in the euro area. In the EU, evidence shows that the non-performing loans, mainly for SMEs and larger corporations, have not increased on average. And in many countries, they have even rather decreased. Now, yesterday I was in a very interesting launch of an OECD report, which shows that bankruptcy rates declined with data up to fourth quarter of 2020 in all countries of OECD countries, except for Spain. But in general, insolvency growth forecast for 2021 shows a positive trend in countries like, for example, Spain, France, Finland, Netherlands, and Sweden. Here we can argue that the massive mitigation actions, such as, for example, the deferrals and all the financial measures that have been put in place, led by the member states, but also by the European Union, to avert the worst to happen in the Union. Now, is this evidence suggesting really that the financial stability has been preserved and also bankruptcies will not happen, or this is a false sense of hope? Now, also I've seen that the ECB has warned that the increasing level of government and corporate debt create some financial stability risks. And this was this week also in the Financial Times. So while the economic outlook is brighter due to the falling COVID-19 infection rates and accelerating vaccinations, but again, the legacy of higher debt and weaker balance sheets of corporations may be hunting a quick and the sustainable economic recovery. So this, of course, raises the questions about the timing of lifting of the mitigation measures and potential necessity to keep some of them. So also, I would like to tell that the ESRB report published in April 2021 on the prevention and management of larger number of corporate insolvencies, which will be also presented today, dives into this discussion. With this small introduction for this webinar, I have really the pleasure to introduce our distinguished panelists. Starting with Martin Omke, who is a professor of finance at the London School of Economics and Political Science, who is also the lead author of the ESRB report. Loriana Pellison, who is also a professor of law and finance, Research Center SAFE at the Goethe University, and contributor to the same report. And my colleague, Daniel Gros, who is a SEPS Distinguished Fellow and member of the Board of Directors. So with this very high-level panelists, I would like to start the discussion, giving the first, I would say, to Martin to present the ESRB report. So Martin, the screen is yours. You have 15 minutes.
Okay. Let me start by thanking you for the invitation to present this report that I had the honor of co-chairing together with Ralf Jakob, who is also in the audience today. But then also, actually, I was singled out as the lead author. I actually want to give a lot of credit for this report to the drafting team, which, unfortunately, relatively small letters we have on the bottom of the slide, but we worked with an extremely good drafting team on this report. So thanks for having me. Let me start with just a little bit of background. So, where does this report come from? I think September last year, the General Board of the ESRB decided to establish this drafting team and a number of other drafting teams. And this particular one was looking into the risks to both financial and economic stability arising from potential corporate insolvencies, right? And to think about, well, how should we think about those risks and what should or could we do about them? And so the drafting team I just mentioned brought together people from a number of macroprudential authorities, EU institutions, central banks, myself from academia, and yeah, as I just mentioned, was co-chaired together with Ralf Jakob. And it's part of a number of ESRB work streams that were launched at that time, all in a way in response to risks to the financial system, to the banking sector, with a focus on macroprudential risks arising from COVID-19. And the report that I'll talk about is available on the ESRB website if you would like to look at it. Okay, so let me get into it. And in a way, if you followed any coverage of this report, you will have seen one word has been singled out more than anything. And in a way, I was thinking about maybe I should take it out of the presentation because there was so much focus on it for today. But then I thought in terms of intellectual honesty and also for the discussion, no, let's leave it there. So question mark, after this first or on this first slide, is what we've seen and what Rim alluded to at the beginning, that actually corporate insolvencies have been or are low right now. Does this mean we're out of the woods, or is this, and here comes this analogy that people have focused on very much, has the water receded before a big tsunami hits? This led to some of the reports saying that this is what we're predicting kind of as a baseline scenario. As you'll see when I present the report, that's actually not our baseline scenario. It is more thinking about one kind of potential extreme scenario. So let's look at the picture as we see it right now. And I think one thing kind of to remember is that the COVID recession is different from a normal recession where, we have this time not seeing kind of depressed economic output in the traditional sense, but kind of it's been suppressed by policy measures, lockdowns, social distancing. And, the expectation, of course, was once these measures can be lifted, then hopefully the economy can bounce back potentially relatively quickly back to pre-pandemic levels, provided, and this is where the bankruptcy issue comes in, that we can avoid lasting scars to the corporate sector. And I think in that context, policymakers realized at the very beginning that insolvencies is an important topic here. And the policy measures, the big policy measures we've seen, fiscal, monetary, regulatory, have, I think, proven up to now very successful in preventing a big wave of insolvencies. There's been a big contraction in economic activities now with some encouraging news bouncing back. But there's actually been, and Raymond alluded to that, a declining numbers of corporate insolvencies. So for example, if we look 2020 in Europe, insolvencies were significantly lower than in previous years. You can see that on the left-hand chart here. They've bounced back a little bit at the very end, but you see this big reduction, right? And if you look at the right-hand side of the chart, you'll see that that's actually the opposite of what normally happens in a recession. And in particular, if we compare it to the global financial crisis, which you have in red on the right-hand side, you see that it's almost like a mirror image. Back then, we saw a large increase in insolvencies. Now, actually, we've seen a relatively large decrease. But as Rim also mentioned on the bottom of the slide, there is an expectation that insolvencies might increase. And so, the question is, what should we do about that, and how should we think about that? Now, why have numbers of insolvencies been so, say, atypically low? Well, in part, I think this is due, we argue in the report, to governments having alleviated the solvency pressures on companies by shouldering much of the financial and economic losses. If you look at this picture, one of these is in the report. We now have more data after the report went to publication. You have here from left to right, first on the top, Germany, France, Spain, then Netherlands, Italy, Portugal on the bottom. And essentially what these charts show is, well, how much income was lost in 2020 compared to the last pre-COVID forecast, and then how those losses were distributed across the three main sectors of the economy: households, light green, corporates in yellow, governments in blue. And as I said in the report, we only have Belgium. We got these figures from the Belgian National Bank for the report. We've now replicated them for a number of other countries. And so what we can see is that through their support measures, in all of these countries, even though there's heterogeneity, governments have absorbed a large part of the shock, right? But I think the heterogeneity is also important here, just to notice already here that probably also in terms of how to respond to potential threats from insolvencies, countries are in heterogeneous positions. And so that's something I'll come back to later on. So the question arising from these two pieces of evidence that we are asking in the report is that, okay, what does this mean going forward? Are we in the figurative sense kicking the can down the road, or have we actually to a large extent already dealt with this problem, right? Here on the slide, what we're talking about is, have we prevented in some durable sense a potential bankruptcy wave, or has it just been postponed, and could it happen later on? And I think here, one of the key things, and this is something in addition to the previous slide that I showed, is that it's important, I think, to remember that at the same time as having absorbed some of the losses, governments have also relied a lot on liquidity measures, moratoria on debt, loan guarantees. Those provide liquidity, but of course, those keep losses induced by COVID on corporate's balance sheet. And so we actually see in the data that corporate debt levels have risen because of that. And that raises the question, on the slide that I just mentioned, has the potential wave been postponed, or have we dealt with it? One other important thing to say here is that, of course, we don't care about insolvencies per se, right? The issue, I think, is, could we lose firms that are actually fundamentally viable business models just because they accumulated too much debt during the COVID crisis, right? Now, also come back to this viability point, which is very important here later on. Relatedly, will these debt levels potentially prevent these firms from responding to structural change that they might have to respond to? Okay, so what we argue in the report then is that, well, the end of the pandemic is not necessarily going to imply that financial stability risks are gone kind of immediately. Rather, the phasing out of the support measures we have in place right now will be kind of a critical moment where potentially, if it's done, say, too quickly, some or many firms could be pushed over a cliff edge given their indebtedness. And so what we do in the report is think about the lines of defense that we have at our disposal as policymakers to prevent the worst case scenario, the tsunami that I mentioned at the beginning. And so starting from the left on this slide, and some of these will relate to things that have already been done, and then I'll get to things that I think the reports would argue should be done now by policymakers, is the first line of defense, widely available emergency liquidity support. That, in our view, was clearly the correct immediate reaction when the pandemic hit. But of course, it also, as mentioned before, increases debt levels, and it can also potentially even make matters worse if you maintain it for too long. So at some point, policymakers want to move to the second line of defense, which is solvency support measures. And those, of course, reduce or avoid unsustainable debt burdens, but at the same time, of course, they add to public debt, and so should probably be more targeted than the very wide net that is cast with liquidity support. And then in particular, what we argue in the report is that now is the time to move on to the third and the fourth levels of defense. And in particular, those are going to be needed as both liquidity and solvency support measures are being phased out. The idea is that many companies will likely thrive again if balance sheet can be repaired, for example, via debt restructuring. And that's the third line of defense. And I'll talk more about debt restructuring and/or equity injections. But of course, there might be some companies that are no longer well adapted to the post-COVID world. Structural change has changed their position, and those might have to be then unwound through efficient insolvency procedures to ensure that that capital and the labor is allocated to more innovative and sustainable uses. And so I want to talk a little bit more particularly about the third and the fourth line of defense. So in particular, what should the policy priorities be as we move from liquidity support to solvency support, the more targeted solvency support, as I just mentioned, and then in particular also as we get to debt restructuring. I'll talk about that on the next slide. In a way, one broad way of thinking about it is that it's all about preparing for kind of a smooth phasing out of support measures, right? So far we have kind of a wide net that's been cast, and that's been very successful in keeping firms afloat. But now the policy mix should likely change from addressing the immediate liquidity needs to the more targeted solvency support. For example, by targeting the sectors that have been hardest hit, tourism, for example, and also by using stricter eligibility criteria than earlier on in the crisis. And here, a key takeaway is, right, that in doing so, what you want to do is try to preserve the going concern value of those firms that are still fundamentally viable. And here, I come back to the topic I mentioned earlier on, which is try to develop capacity to identify viable firms. In particular, those, and I've highlighted them here on the slide in the red and the yellow box, that post-COVID still have a viable business model, but because of debt burdens accumulated during COVID might have difficulties moving on, operating without support, solvency support, or restructuring, which I'll come to now. Right. So I think to achieve this transition, then, in conjunction with solvency support, what member states need to do is create the right conditions where those viable companies that I just highlighted in red and yellow are able to restructure or repair their balance sheet, for example, by restructuring their debt. I've mentioned through the public loans and guarantee schemes, a large amount of debt has been built up. And so actually, because of that, the government now, in a way, has a large stake in these companies. And so I think also from a public finance perspective, successful debt restructuring for those firms is going to be something that's going to make sense. And a lot of those firms, I think, are going to be smaller firms, SMEs, which are going to be important for the recovery going ahead. And so what we do in the report is try to outline some of the best practices here. And I won't talk through all of them in the presentation now, but these include early identification of distress, clear rules on cross-border insolvencies, and in particular the availability of restructuring. And we talk about some examples in the report. Member states are beginning to do these things, right? So 2 examples that we focus on, but there are more. Preventive restructuring regime that's been implemented in some member states, including in the Netherlands, or the provision of public support in France as part of the debt remediation scheme that exists there. And the report also talks about some academic proposals on how to set the right incentives for restructuring, for example, through tax subsidies and things like that. But of course, at the same time, we should be clear that not all companies can or should be saved here. So structural change is happening, and some businesses are not going to be viable post-COVID. And so the report is not arguing for helping all of these companies restructure their debt. Rather, those companies hit by structural change, for them, trying to develop efficient insolvency procedures is going to be important. Swift liquidation of assets so that we can reallocate those resources efficiently. Okay, I think I'm actually nearly out of time. So let me just give a couple more specific points here, how the debt overhang that could at least be, in some sectors of the economies could be addressed. What could governments do, right? So, well, under the state aid framework, there is currently additional flexibility, for example, to convert repayable liquidity support into grants. So direct grants are a way of proceeding. In France, for example, the government has proposed to convert some of the guarantees loans that they've made into grants, at least for small businesses that are hit hardest by the crisis. Germany apparently is thinking about recapitalization instruments, particularly equity or hybrid capital instruments, which could be an interesting option. And there are many other kind of innovative examples that are being considered right now. The other thing I quickly, before I conclude, want to mention here is that banks probably are going to play an important role here, both in terms of trying to give the right incentives for banks to restructure and also bring their knowledge of the companies and their economic situation into the restructuring process. So, for example, in Italy, there are schemes where restructuring by lenders is being incentivized right now with tax credits, where ultimately both the investor who restructures receives a tax advantage, and the investee receives an equity in investment that hopefully will help repair the balance sheet. Okay, I'll conclude so that we have a good amount of time for the other speakers and just a broader discussion, right? But I guess the punchline of this report, to come back to my beginning, is not really that we will see in the next year a tsunami of insolvencies. It is more about remaining cognizant and vigilant of the potential dangers in terms of insolvencies and risks that are still there. I don't think the tsunami is the baseline scenario, but I think in phasing out a liquidity insolvency report, it is important to remain vigilant and to kind of tread carefully and get the sequencing correct, so that hopefully, that word that many have picked up as a prediction of the report, the tsunami, is actually not going to materialize. I'll end right here, and I look forward to the discussion. Thanks very much for your attention.
Thank you very much, Martin. This is very interesting presentation. And there is one question that I will leave for later on, is the sectoral effect, because not all sectors in the EU have been hit the same way. So probably all this sequencing on all these measures that you propose to address the debt overhang might be looked at also at the sectoral level. Thank you. I would like to move straight to Loriana for the discussion, please.
So thank you very much for the opportunity to, let's say, discuss and sometimes also add other comments to the very nice work that Martin and Ralph with the rest of the group, but clearly, Martin did contribute a lot on this document. And so my perspective is, in some sense, mostly on what will be the implication of all these corporate insolvencies in terms of financial stability. So what it has been shown is that so far, a huge wave has not been materialized, but you never know. And, I want just to stress that clearly on this side, what I'm going to say today is largely based on a lot of discussion that I did with some of my colleagues. Here, we were presenting and discussing already in March what will be the implication of this crisis in terms of financial stabilities, what really, needs to be done in order to intervene from the public side in terms of financial support and so on. And so what I'm going to tell you now is not just only what I was thinking, but long discussion with all these people. And several other work that I have done also with Elena Carletti and Marco Pagano on the situation in Italy. And one of the points that we are making all over is that maybe you are not having insolvencies, but for sure, this huge shock that COVID has represented and is still representing has increased a lot the fragility of the firms. So, for example, we have this graph in our paper that is showing firm leverage distribution in Italy for the different level of lockdowns. And one thing that you can see is that here leverage is equity over total debt. It is clear that firms before the shock, so for database on at the end of 2018, do show a certain level of leverage, but this leverage clearly is going to increase in an asymmetric way. So you have some of the companies that do not increase leverage too much, but there is a significant fraction that do increase leverage very large, and some of them, maybe as soon as the support will stop, can default. So as it has been stressed, the impact was heterogeneous across sectors, but was also it will be also heterogeneous across different firms. And also the one that will survive, for sure, will remain more fragile. This is why we were asking quite a lot for an equity injection, so an help from the equity point of view of firms. But there is another thing that I want to stress, and this work that we did for the European Commission on non-performing loans and how to handle them. Because, you know, in any case, even if we are not having too many insolvencies, we may have that firms are not able to satisfy immediately their, let's say, their debt. And what we learned from previous crises, even if this crisis is different, should be taken into consideration, because, you know, it is true that this crisis is not coming from the banking sector. It is not a crisis that, you know, it is quite symmetrically affecting all Europe. So it's not related to some particular countries due to, for example, the high debt that they are having, but, you know, it will generate some non-performing loans that need to be managed. And we in this report pretty much 5 lessons that can be considered important on how to handle non-performing loans. And the first one is that as soon as, you know, the fiscal support will be unwinded, it is extremely important that banks, so the banking sector, will identify and recognize in an efficient way, so distinguishing as soon as possible viable versus non-viable firms, because if they're not doing this, the effect will be that we are not going to see this next year and not the year after, but in 5 years, or later on, we will have that a huge zombification of the system. So zombie firms and zombie banks. And this will have a huge impact on the GDP growth. And given the significant debt, public debt, that this crisis has in some sense generated, well, this will be even more, let's say, perverse. The second is that banks, in order to do this job, they need to have the right incentives to really identify non-performing loans. And in order to do this, the regulators do play a significant role. And this is why asset quality reviews, stress tests, adequate accounting rules will provide the right incentive to banks. This is why the stress test that the EBA now is doing, it is extremely important. The way in which they're doing it, it will be extremely important because will help, you know, in some sense, to go into the direction that Martin already stressed, that we need really to be able to distinguish viable and non-viable firms. And the other thing that we learned from the previous crisis is that, you know, forbearance via or public bank recapitalization will have adverse incentives to banks. You know, banks has already started to say, you know, well, the government via fiscal support pretty much help everybody, you know, help Lufthansa, help the workers, help the families, help the entrepreneurs. Why not banks? We have already this story going around. So, and we need to learn from past crises that this is very dangerous. So, because it is already providing ex ante a very perverse incentive to banks to not recognize the non-performing loans. And this will then generate zombie firms and zombie banks and no GDP growth. And the last lesson that we learned from the past is that if we want really to move on with non-performing loans, we need to have a proper secondary market for non-performing loans. And in order to do this, you know, you need to try to match the fact that banks would like to sell at a very high price, these non-performing loans, and clearly the buyer, the investor, would like, of course, to buy at a far lower level. And this difference that at the end is preventing this market to fly is due to asymmetry of information. So we need to provide information to the market and collect and make public the information about when these companies are really starting or stopping to pay back their debt. But on the other side, banks should have the incentives to recognize, to write down loans that are not performing. Because if they do not write down loans that are not performing, they will never sell in the secondary market these loans, and we will never have the secondary market of non-performing loans. So those are pretty much the 5 lessons that we are learning from past crises that will help us to handle large fraction, small fraction, you know, whatever it will be, fragility in the different firms and distinguishing viable versus non-viable firms. So thank you very much. I think that already I use already too much time.
Thank you very much, Loriane. I think you put a focus on very key issues, mainly the how to separate viable from non-viable firms by banks and the incentive issue. And we have these discussions at the European Banking Authority several times with banks, and it is clear that well, let's see what incentives they have and whether the regulatory framework will give them further the incentives to do it or not, specifically now with the whole debate about the implementation of Basel, especially the Basel IV, the last. So I would like to move straight away to Daniel. Daniel, please.
Thanks a lot, Rim, and most of all, thanks a lot to Martin and Loriane for their contribution today and presenting the report. Let me pick up 2 points which Loriane already mentioned. First is a sectoral issue, right? We know that a number of sectors which have been affected directly, indirectly by COVID, and others not. Now, my estimate is actually that the sectors which have been affected are a rather small part of the economy. They have been affected a lot, right? Travel companies have not lost 5% of their revenue, sometimes 50%, but they represent a small part of the overall economy. And there it would be interesting just to see what part of total credit goes to these sectors. Are they particularly credit intensive? That is one question. And the second question comes to the fundamental choice which you, Loriane, mentioned, and Martin a little bit less, I found. Namely, that's the trade-off between avoiding lasting scars to the economy and to enterprises, and preserving the pre-COVID industrial structure, part of which might not be viable post-COVID. Now, I know, Martin, you showed this yellow group of enterprises, but I very much doubt that we, you and I and the supervisors are the ones who are best qualified to identify these enterprises. And to the extent possible, we should have market mechanisms. And I think Loriane outlined already the importance of giving banks the incentives also to do so. But also, I think if you take a look at these two elements, the sectors, which I mentioned earlier, and the importance of avoiding scars. Now, we think it's important to avoid scars when we have sectors with high human capital intensity, especially high firm-specific human capital, which we want to preserve. Now, if you think about travel, if you think about retail, if you think about restoration, are these areas or sectors where we have high human capital? High specific human capital? I must say, I don't think so. I think you might have actually the data on how many restaurants are opening every year and closing every year. So is it really justified to say we should avoid scars in these sectors? Maybe we need some change, especially in our retail distribution sectors, because one thing we know that maybe people come back and travel. They come back to restaurants. But will their shopping habits change? Probably. How quickly? Nobody knows. And that is, I think, an area where there's lots of employment, lots of marginal enterprises, maybe often in the gray area of the economy. And that's where we need the most structural change. Let me perhaps finish with the overall issue, which Martin mentioned at the very beginning. Namely the question, is there a tsunami out there waiting for us? Big problem with the balance sheets of enterprises. And now I will try to share my screen with you, just showing you exactly two charts, which I hope you can see. These are directly charts, not very nice, from Eurostat. And the first one, which I show here, is just as it says, I hope you can see it well, the gross profit share of non-financial corporations. These are the things banks are supposed to lend to. And if you look at it, you see two troughs here in 2009, the first recession, then the Euro recession, and right now it doesn't look so bad, right? And then perhaps let me jump. This is how much profits enterprises made or lost in 2020. Let me add what I find interesting is the things that happened before the crisis. You remember we already had a sort of manufacturing recession in Europe. And you see it here, 2018-19. So actually the COVID crisis came when we had beforehand a manufacturing crisis, and now the manufacturing sector is actually booming. So let me, however, come back then to the question. I hope it works. Here you should see the stock of financial assets and liabilities. And you see perhaps lots of colors, but if you can please concentrate on the dark black line. That is the net financial wealth of non-corporate enterprises, non-financial corporates. And what you see is actually it has improved since the crisis in 2009. Moreover, it has continued to improve during 2020. So as a sector, the corporate sector is now stronger than it was, let's say, 1.5 years ago. And that tells me that while there might be some pockets in the restaurant sector or others, it is highly unlikely that there will be a tsunami or a big wave of important corporate insolvencies out there. So I think when we look down from your nice picture, Martin, at the end, the sea looks calm, and actually we don't see big monsters lurking below the surface. So I would say be happy. This is not the major concern I would have at this point. I would rather go with Loriana's point that we should really make sure that we don't impede much needed adjustment by being too lenient on corporates which cannot service their debt and on banks who have NPLs. Thanks a lot.
Thank you, Daniel. So according to you, the regulatory and all financial measures put in place to mitigate COVID should be lifted soon.
They should be lifted soon. Can I perhaps add something which is in general? That is understandable. These supervisors, they are paid to avoid visible damage to the economy in the form of scarce insolvencies. The invisible cost of lower growth, which Loriana mentioned, right? That's not part of their incentives. And therefore they err on the side of caution.
Okay, thank you. Okay, I would like to give the screen to Martin to give his view about what he heard from Daniel, and then to Loriana.
Great, thank you very much. Thanks both to Daniel and Loriana for the comments. I think Daniel made some very interesting and very good points. But I also think some of them actually are not necessarily in contrast to how I think about the issues. For example, if we start with the last point that we talked about, which is structural change and long-term growth. My view is that some of the policy measures that our report promotes are actually ways to deal with that. So what I have in mind, for example, is that the high indebtedness in certain sectors can cause insolvencies, but it can also, through debt overhang, prevent these companies from adapting to structural change, investing efficiently. So I actually see, the debt restructuring, which I think is important, and giving right incentives. Loriana talked about that, to banks going forward, I think will be very important. And it is partly important to, I think, preserve, and I'll come back to that in just a second, to preserve some businesses that might otherwise go under. But I think it is also important to remove the debt overhang so that business actually invest in and you know, we don't get zombies in that will slow down the recovery. So I actually think, you know, at least some of the policy measures in the report in a way try to deal with both of these issues. I think the other big point that Daniel made, and I think that's a really important point, is, well, you know, who is actually, and Loriana showed, you know, that the average financial position, I think, masks a lot of heterogeneity. And so I think that it is indeed important to think about, okay, who are the businesses, the companies that are in trouble? You know, Danielle mentioned, I think, travel, retail, restaurants, and so on. And then I guess the question is, okay, is this something we should be concerned about? And I think Danielle's view there is slightly more optimistic than my view, and I'll try to explain why. It might be true, I think, that there are sectors where there's more firm-specific human capital, but at the same time, particularly when we have sector-wide shocks, I worry that the resulting bankruptcy costs of those firms, even if they don't have a lot of specific human capital, you know, even very small businesses having to close, reopen, and in particular for small businesses, actually, I would argue the bankruptcy system, insolvency system probably is less efficient and less effective than for larger corporations. So my view actually is that I'm not that worried about, you know, the big monster. I'm not that worried about a big corporate going bust. What I'm more worried about is a large number of smaller, perhaps even to very small businesses and companies. And I think, you know, the resulting frictions in trying to reestablish those businesses, reallocating if they were to default at the same time the assets, potential fire sales, you know, whatever you want to think about, I think could lead to substantial costs. And so that's why even for those sectors, my own view is that we should be vigilant. I'll leave it there. I'm happy to continue the discussion, but maybe pass on the mic.
Martin, I have one small question. It's about the role of digitalization, because many companies, they have adopted very quickly their business models into digitalization. So even in those sectors which were supposedly to be hit by the corona crisis, this digitalization potential, especially in Europe, has helped those companies in a way to be more resilient. What do you think about that?
Well, I think one of the big challenges in, you know, we mentioned viability assessment. One of the things that makes it challenging is that, of course, through the pandemic, people's consumer preferences and so on have changed, I think, and business models, I think, have changed. I think to some extent, I think it is kind of encouraging that a lot of businesses manage to adjust, you know, relatively quickly. But of course, that makes it particularly hard. And we mentioned that, I think we have a box in the report on why viability assessment, even though we really would like to and should try to somehow or through the market have that happen, is particularly difficult because a number of things changed at the same time, so that perhaps, you know, the usual ways we would try to do that don't quite work because, for example, what the economy will look like post-COVID is uncertain. And they actually very much agree with Danielle that the aim here, the policy aim should not be, let's go back to 2019. Right. I think we should try to let the structural change happen. And I think some of the changes, there are some that will be temporary and companies will go back to the way they used to operate. But then definitely there are sectors, I think, where there has been permanent change to how business has been done. And I don't think this should be dialed back. I completely agree with that. Yeah.
Thank you. Now I give the floor to Loriana.
Yes, so thank you very much. Actually, sometimes I have more questions than answers, and I have a question to Daniel in answering to his question. It is the following: you know, there is a big elephant in the room. You know, even if I share your view that you know, we shouldn't preserve all the firm that we already have, mostly because we were already in a transformation and there is all this revolution from the digital side and so on. Do you think that from the political point of view, it is acceptable what you are proposing? So I don't, at the end, I think that it is not only, I see the problem that Martin is seeing from the legal perspective. We don't have maybe the capacity at the legal level also to handle this type of situation. But I think that before, even before this, I am concerned that we don't have the political capacity to accept this. This is one thing. The second thing that I want to stress is that not only we are already observing a long revolution on the manufacturing, let's say, sector and digitalization of the society and so on, but even the banking sector, before to enter into this crisis, it was already under a long revolution from in terms of disintermediation and moving from, let's say, a system where banks were playing a significant role into, you know, a framework where non-banks are playing now a more significant role. So even under this perspective, we need really to try to be sure that on one side, we are able to avoid zombie firms and zombie banks. We need also to use this opportunity to restructure the banking sector, because we are characterized already by several years by a banking sector that is not so profitable. And we have a problem of overbanking. You know very well, you know, the document that you contributed also to write at the ESRB. So let's try to put all these things together. So in some sense, maybe it is nasty, but let's use this crisis. That's my suggestion.
Yes, thank you, Loriana. I also have one question to Daniel, and I give you the screen. Do you think the ECB warning on the increasing debt at the government and the corporate level, it's overstated in terms of the financial stability concerns, particularly when the cost of refinancing this debt nowadays, it's very, very low, almost negative in some countries. So how do you see this? Are we moving into an economic model which is funded, in fact, via debt?
Yeah, thanks a lot. By the way, there's a question by somebody from the audience, Ralph Jakob.
Yes.
First to Loriana's question. I think, why waste this crisis? Let me take the retail distribution sector, where we know we have had a large lag in productivity growth with respect to the United States, right? And we know that there's a large number of marginal firms, units in this sector. Now would have been the possibility for the governments to say, not you get a subsidy if you stay in business, right? And we tie you over until the end, but to say, okay, here's the sum of money and you get it anyway, even if you close down. Actually, even better if you close down, right? This is the kind of incentives which I found were missing, right? Or let's take another example from Italy, that you're no longer allowed to fire anybody. It should be the opposite. You should make it easier for corporations to fire, and you can be more generous with workers to protect the workers as opposed to their jobs, right? So I think this is the missed opportunity, 3/4 missed, but maybe for the end we can still do something. So that is, I think, very important. The second point is that banks, they are not, we know the relative advantage of banks is relationship lending, right? You know a company forever, you think you know the owner is honest, and so on and so forth. But that model doesn't work in a sector where you might have many new innovative enterprises, even retail or restaurants, who have no track record, right? And of course we ask our banks, please give them credit, basically at very low interest, and trust them. Yeah, but since banks get only the downside, right, and not the upside, the banks are not suitable to do that. So I think we shouldn't put our hopes in the banking system anyway to finance structural change.
Okay, there is
yeah, well, just a quick reaction. You know, remember that there is also this type of, let's say, of flavor that banks play a significant role during this crisis because they were, from the social point of view, helping the government to give the money to the firm. So taking this position, it is very unpleasant, of course, and irrespective of what banks have done so.
To my teenagers, what do I give? Tough love or love?
Okay, there is one question from the audience. Do you think that in addition to or instead of conversion of loans into grants, national governments could provide targeted debt relief to corporations, especially for SMEs in sectors hard hit by the corona crisis? And then whether there is a role for the EU to give broad corporate support to preserve the level playing field, and then to avoid further national fiscal burden. I start with Daniel, and then I go to back, and then Loriana, and then Martin. Daniel, what do you think? Unmute yourself, Daniel.
Converting loans into grants, especially for SMEs, I would say no. I would say maybe we provide a lifeline to SME owners who typically might have given a guarantee or so, right? We can do that, but we don't want to prolong agony, which in many cases, as I said, we have many marginal units in that sector. So yes, we protect the individuals, but I would not transform everything from loans into grants. At most, sometimes into equity, and in SMEs, many cases you take a hit.
Loriana?
Yeah, so I'm perfectly in line with the idea that we need to help householders, so let's say workers, and really what we learned from the previous crisis is that we need to clean up. If we are not cleaning up, we will never end, and we will have such perverse effects later on that will be far. And the main problem is that we will not have the measurement of this, because that's exactly the problem. If people are unemployed, we have a tangible evidence. But if there will be no growth, well, we have only the evidence because some other countries are growing and your country is not growing, and then you have all the potential story of why this is the case. But there is already evidence that this is the case because you have a lot of inefficiency in your production system. That's the problem.
Okay, Martin.
I feel like I'm a little bit less of a hardliner on this question. I just worry that just assuming that a lot of those businesses are marginal and not productive business, I kind of worry a little bit that then not helping those companies reduce, SMEs say, reduce their debt burden will lead to a situation where once support measures are being phased out, those companies, suppose it's a company that still has a good business model, but over a year of lockdown has accumulated a lot of debt. And I do think in many cases it will make sense, even for the long-term recovery, to eliminate that overhang, to do something about that. Now, whether that's done through a restructuring or to grants, we can have a discussion, I think, about that. And I think, there are pros and cons. I think we talked about the fact that incentivizing the right kind of restructuring, by banks might be difficult to do, might be regulatory impediments. So we have to think about that. Grants, maybe it's easier to do, but on the other hand, of course, maybe you risk being overly generous. They also perhaps add to, a fiscal burden. So I think, we can have a discussion about what the best way of doing some of these things are. But I don't feel like saying, oh, we should almost in a way categorically not give grants for debt that was accumulated, say, during the lockdowns. I feel is a little bit, for my taste, too kind of hard of a position. I see, I am on board with the argument for promoting structural change and innovation. But I just wonder whether this measure would maybe be slightly too tough, I guess.
Yeah. So we also have on screen Ralph Jacob. Ralph, do you have any comment on all of this, please?
Thank you very much for inviting me to join this discussion. I feel very privileged. I would just like to respond a little bit to the question of how optimistic or pessimistic we should be. I mean, in the ESRB context, I think we should be professional pessimists. We should be seeing the next financial crisis lurking around the corner and thinking about what we can do to prevent it from happening. In this case, I think if we look at the averages, we probably wouldn't be worried too much. But we need to look at the heterogeneity, which Martin mentioned, and we need to look at political acceptance, which Loriana mentioned. What I fear most as a professional pessimist now is that we might have some countries hit particularly hard. That could cause political difficulties within the countries, big tensions within the Eurozone, and that would be the trigger of financial instability, of a crisis for the EU, for the Eurozone in particular. So that would be my main fear. Apart from that, I agree with a lot that has been said. We just shouldn't forget this particular aspect, I would say.
Thank you for joining, Ralph, the discussion. I would like to ask a last question to Daniel, which is from the audience again. Who is, in your view, should finance innovation?
Should or will? we all want to have venture capitalists coming down to earth and having innovation funds, right? And we have had hundreds of European initiatives to get it going. ASIF and other things should, not the banks, right? That seems to be not their business model. Ideally, capital market, ideally venture capitalists, but we all dream about that and nobody knows why it doesn't work in Europe. Can I just add something on the structure? What I would have expected then from the report would be to say, okay, overall, no problem, but how does the financial situation of enterprises in these sectors, tourism, retail, and so on, look like? Does it look very bad? Are they mainly small? Are they large? Are they capital intensive? What was their productivity distribution before? These are the things perhaps that you should document.
That is clear that more research is needed also on assessing or doing an impact assessment of all the possibilities on how to deal with the debt overhang. I think this is important to do it as soon as possible, to see which are really the pros and cons for each measure going forward. And this is something that could be also done by independent organizations like CEPS and others. So I think we are almost out of time. We are almost 4 o'clock. So I would like to thank you all for this very good discussion. And I'm sure we have not covered, all the set of questions about the timing, when are we going to be lifting all these measures, but clearly that we will see. And the ECB and also the ESRB and the EBA should continue monitoring the risks and vulnerabilities in the European economy, so be it bank or other also firms. And we will probably meet again to see where we are in the next 6 months, and hopefully we move into more certainty after all this progresses that have been done on the vaccination, so less uncertainty on the health crisis. So I would like to thank you all for this very good discussion, and I would like to thank the audience and CEPS for organizing this very